Stocks dip with declines outnumbering advances but are off the lows of the day. Auto, IT and healthcare are the big drags, even as financials and capital goods eke out some gains.
The elevation of CEO Gopal Vittal to Vice Chairman and transitioning CEO designate Shashwat Sharma to the leadership role weighs on the Bharti Airtel stock, even as it posts strong revenue growth on higher tariffs.
The JSW Group has inked an MOU with Korea's POSCO to set up a 5 million ton integrated steel plant and explore collaborations on battery materials and renewable energies.
Federal Bank perks up after slippages dip to a 15-quarter low and asset quality improves. Business momentum too remains strong, but deposit growth lags.
And the Secretary to the Department of Economic Affairs tells CNBC-TV18 in an exclusive interview that 7% growth in FY25 is very doable, with strong growth expected in the second half of the year. He also rules out any additional government borrowing this fiscal.
It's an extremely interesting day of trade that we have for you. You're watching us here on Halftime Report. I'm Mangala Malu. With me, Hormaz Fatakia. The Nifty down about 100 points, but from the lows, we've seen a near 100-point recovery as well. And the low of today coincides fairly well with yesterday's low. What's leading the market up, which is Nifty Bank. Yesterday as well, we did see the Nifty Bank do extremely better. Right now as well, if you look at it over the last few minutes or so, the Nifty Banks climbed to the high point, the higher end of today's trading range. So let's see where that goes. Very close to its 50-day moving average and the 100-day moving average. So we'll keep an eye out on those technical levels too. And the good part is the broader markets. You know, if you look at the mid-cap end of things, you have the mid-cap index, which had been fairly volatile. Currently, again, is trying to make a bit of an attempt at recovery. And that coinciding with the crisscross lines that come up for you, we did see a lot more stocks decline than the number of stocks which were advancing earlier. And now those lines seem to have come closer once again. Can they intersect and move higher? The second half of trade will be extremely crucial to track. We do have a bunch of stocks which are doing extremely well, Hormaz as well. Gillette is one of them, reported good numbers. What is it that the company is doing? Despite there being a macro trend of beards and not many people shaving, they've increased their distribution. They've increased their end of, premium products. And they said, why just address the male part of the population? Also look at the female part of the population. So Venus, one of their female grooming products, doing extremely well. So just to quickly run you through the numbers, we have, Gillette revenues grew by about 17% at a time when every other consumer company is complaining of a bit of a slowdown. Their EBITDA, lower steel prices helped them as well, was up around 38%, and that led to a 43% price growth. The grooming business, out there, a 23% revenue growth came by, and we had the EBIT grew 67%, telling you that the margins jumped from about 18% all the way up to 24% itself. It was distribution expansion, female grooming range, which did well, and increased traction to high products, which did extremely well for Gillette this time around. So let's see whether this outperformance sustains or not, because the company in its analyst meet had clearly said that the reach and their coverage has increased by 1.5 times in the last 3 years. They have embarked upon a cost savings and premiumization spree, and male grooming, which is a $33 billion rupee category, is growing in mid-single digits, but they have their highest ever market share out there. And female razors has doubled in sales over the last 5 years and now contributes double-digit to their grooming sales as well.
Well, best quarter an investor can get, gender agnostic as well. Very strong earnings from Gillette, and it's showing up in the stock price as well, 8%.
For people like us, the volume growth will always be there. Both of us and a lot of them in our profession, we have no option but to be the Gillette people.
Exactly, we have to be there. But yes, indeed. But then on the flip side, there are certain stocks that are not doing so well after earnings. Spandana Spurti is one of them, and that is after the earnings reaction, a very sharp deterioration in asset quality, a jump in the provisions as well on a sequential basis. The stock is down 17% and a significant shave off in today's trading session. Remember, the stock was down almost 20% a month before yesterday's earnings announcement as well. So that now is adding on to that. So moving on, then some other earnings reactions. Sun Pharma, the first management on the show, had reported an inline quarter. Margins were aided by the global specialty sales and lower R&D. In fact, Vinny Motiwala caught up with CS Muralidharan, the group CFO, and began by asking him about the strong performance in the US market. Take a listen.
So our overall growth in the US, we have seen in the current quarter, has been good. The growth has been fueled with our specialty key products like Ilumya, Odomzo, Winlevi, Cequa, and all have contributed very well in the current quarter. And we continue to focus on strong execution which has led to the overall scale of our specialty business over the years.
Okay, Muralidharan, if you could just talk to us about what is the growth ex Revlimid also?
We do not want to give any specific guidance for any product or product segment as such, excluding Revlimid.
Okay, so but overall the growth for Revlimid was strong this time. How could we be saying the performance was? Because I believe the last quarter wasn't as exciting in terms of Revlimid growth is what we're understanding. So any indication on that?
So we have already said in the earnings call yesterday that the sales of Revlimid in the US for Q2 was large as compared to Q1 of FY25. And the sale of the generic lenalidomide tends to be episodic and fluctuates between quarters.
Okay. What about, in a press release, you're highlighting about leveraging the cash position that you have in your books. One, what does it mean? And does that mean that you want to focus a bit more in terms of the specialty business? Is that how we should be looking at it?
Yeah, we will continue to focus on the core therapy areas for business development, example like skin, eye, and skin cancer. Overall, our net cash position at the end of H1 was approximately $2.6 billion, which gives us a position to undertake appropriate transactions.
Okay, but in terms of specialty business specifically, that accounts around, I believe, 10% of your profits right now. Do you see this reaching the 30% mark in the next 3 to 5 years? How will this also drive your margins, if you could give us an indication? Because specialty business obviously has better margins.
Yeah, see, the net profit growth has been led by a sales growth as well as margin improvements. Our overall sales growth was broad-based, with most of our key geographies performing well, but India and US in particular. Mm-hmm. And the margin improvement is a result of our product mix leading to better gross margins.
Okay, but so specialty business, how do we see that moving and the margins going forward also, if the focus continues to be on specialty?
So just to reiterate, the global specialty sales for the current quarter was $286 million with growth of 19.2% year on year, which accounted for 18% of consolidated revenues. For the first half of the year, the global specialty business was $552 million, growth of 17% year on year. And all our key products in specialty portfolio are doing well, and we expect them to perform well in the coming quarters.
Okay, so this growth of 19% is something that is sustainable, and we will see further improvement and focus on this one. Okay, sir, but I want to know in terms of the research and development expenses and the spending. Obviously, you spoke about it in your con call that you've lowered the spending guidance to 7 to 8% for FY25 from previous 8 to 10%. One, does that mean the second half of the year we'll see an increased terms of spending? How does that work? And also in terms of, will we see a significant pickup in terms of clinical trials that had seen a delay also?
Yeah, see, some of our clinical trials for specific issues have been pushed ahead, which we have mentioned that they will be starting in later part of the current fiscal. And as a result, we have guided the revised guidance of 7 to 8% of sales for the full year as our R&D spend, which definitely indirectly means that in the second half we'll be spending much higher than the first half.
Okay, and just, when you talk about the company's research and development spend, right, when you look on the absolute term basis, it is a good amount that you look at it from the company's point of view, around 3,000 crores, versus peers who cannot be spending so much. So does that amount on absolute basis continue to be this strong going forward?
No, we have always mentioned that we'll continue to build our global specialty product portfolio, and we will not shy away from any compelling investments to make the portfolio very stronger.
Okay. And what about the outlook, especially coming in for the emerging market side as well as the rest of the world? And would the focus markets now come in? Which are the focus markets from the emerging market front?
See, there are certain 4 to 5 large markets out of the basket of complete emerging markets, namely Romania, Russia, Brazil, etc. And as such, we maintain our revenue growth guidance, which is high single digit given for the year.
Okay. And Illumia, you mentioned that you're seeing good growth there, good growth trends. Could you just give us a bit more highlight in terms of expected launches there, and plus an update in terms of the phase 3 trial for the new indication, which was for the psoriatic arthritis drug? Any update on that front?
So for the psoriatic arthritis, we expect the top line data by end of 25.
Okay. And what about anything else in terms of Illumina side? Any specific trend that you're seeing there? And do you expect it to be strong going forward?
No, we expect the specialty portfolio to continue to perform well, comprising of not only Illumia, Odomzo, Winlevi, Cequa, all have traction well, and we expect them to perform well in the coming quarters as such.
Okay, I just want to highlight in terms of Winlevi also. How is the growth here, and what are we seeing in terms of an improvement in terms of your prescriptions on that front? Are you seeing a sequential improvement there?
Winlevi continues to perform well, and it meets our expectations.
Meets your expectations, and if you could just highlight what was the expectation that you're keeping for the Winlevi?
So we have consciously worked towards improving the realization per prescription, and it is working well.
Okay, so you are seeing an improvement in terms of realization per prescription, because that was the change in strategy. So yes, that is something that you're watching out for. And just lastly, if you could just give me a highlight in terms of the Lex-LV litigation that is going on. Any update on that front, or what are we watching out for? Because if there's a delay, then I believe December 26 is what we're watching out for in terms of the launch here.
So as the matter is currently sub judice, we will be unable to comment any further on this litigation.
The management of Sun Pharma there in conversation with Vinny. The stock currently trading at the lowest point of the day, 2% lower at 1865. Take a short break. Corporate conversations continue on the other side. The management of Arvind SmartSpaces joins us on the other side with Managing Director and CEO Kamal Singhal.
Welcome back. You're watching us here on Halftime Report. The Nifty Bank now surging as we speak, up around 500 points at the high point of trade. And we also have strong numbers coming in from Ami Organics. The chemical space has been in focus, a 43% revenue growth, and that reflecting all the way under the bottom line where, there has been a positive profit as against loss in the same time last quarter. The EBITDA has almost doubled, and the street is rewarding that. A big surge is what we've seen in the stock price, up 11% as soon as those numbers hit the wires. Margins at 20%, 40 versus 14.4%, and net profit of 37 crores versus a loss of 19 crores at the same time last quarter. 43% jump in the revenue, resulting in the EBITDA doubling as well. But speaking about numbers itself, another good set that came in was from Arvind SmartSpaces. Good bookings growth. However, we did see the collections fall year on year in the second quarter. Let's, get to the management. We have Kamal Singhal, who's the Managing Director and CEO, joining in. Thanks a lot, Mr. Singhal, for joining in. Wish you and your team a very happy festive season ahead. On the bookings front, first half, you've done nearly 666 crores. You were looking to launch around 23 to 2500 crore worth inventory in the remainder of this year. When you said to us very recently when you joined, what's the guidance of bookings for this year? Will you be able to do the 30% growth that you're targeting in the second half this year?
Yeah, very good. Good afternoon, and wish you very, very happy Diwali to you all as well. As we said, we are very hopeful that as we talked last time, a growth of over 30%, 30-35% should be achievable, and we are on track to do that. First half has been great. This quarter has been great. We've had a very, very healthy growth of 26% in bookings for this quarter and 32% for this half already. And we are hoping that the rest of the year will go the same way, and we'll be able to touch this 30-35% growth target for the year as a whole.
Mr. Singhal, good afternoon. Festive greetings to you. You've mentioned that you're targeting around 23 to 2500 crore, right, worth of inventory launches this year. What has been the number in the first half, and what would you be expecting to surpass the target that you have given in the second half based on the first half number?
So we have launched around 900 crores worth of inventory in the first half, and we are hoping that in total we should be able to launch 2500 to 3000 crores of inventory. And that's where we are as of now. We should be able to achieve the target that we set for ourselves in the beginning of the year, and the way we talked last time on this.
All right. What about, debt? You said that you can comfortably raise about 300 to 400 crore of debt. You do have about 800 crore of free cash flow from operations. I just wanted to know, are you looking at any sort of fundraise in the very near future by either debt or equity?
Yeah, sure. I mean, debt for sure we can raise. The balance sheet gives us a lot of headroom. As of now, we sit on a surplus of around 200 crores in the balance sheet. And obviously, even keeping the debt equity ratio at a very conservative levels to raise 400 crores should not be a problem. And that's what we want to do in the remaining part of this year. All in all, right now, the company is in the process of investing around 1,200 crores in near future in next couple of quarters. And that obviously to the tune of 300 to 400 crores is part of that. And the rest will obviously come from platform and internal accruals, which are otherwise very healthy. Last 2 quarters, we have generated more than 200 crores already. And that's how this also is an important component. So all in all, 1,000 to 1,200 crores, including 400 crores, 300 crores of debt is something that we are targeting for this year.
What's the launch pipeline looking like, Mr. Singhal, for the rest of the year? You mentioned that you're confident of from 900 crores, you're confident of going to 2,500, 3,000 crores for the rest of the year, which means around about 1,500 to 2,000 crores worth of projects in the second half. What's the launch pipeline looking like? And how much of your unrecognized revenue will also be recognized in the second half? If you could share a number on that.
So all in all, I can give you a sense of what is the total unrecognized value of sale, which is already there, not recognized in the books of account. That's more than 2,500 crores now, but that's the total number. And this gets recognized over a period of time, maybe in next 3 to 4 years. Apart from that, the fresh sales will continue to happen in the balance part of the year. As we said, last year we did 1,100 crores of total sales. This year we are targeting 35% growth over that. We have recognized part of that already in the year, 340 crores to be more precise. So all in all, we should be able to meet the targets on launches, which are 2,500 to 3,000 crores in total for the year.
And how much of your unrecognized revenue will you recognize this year? If you know that graphic comes up for you this year, you have close to around 2,500 crore worth unrecognized revenue as well. How much do you intend to recognize in the next couple of quarters?
So that will be a difficult call to make. I mean, the accounting standard basically makes it contingent on how much of the project or how many of the projects get finally completed. So that's a little difficult to predict at this point in time. But this will be as per what we have been expecting, which is a growth of over 30 to 40% that we've been showing in the past as well. But difficult to predict the books of account. Booking side is more predictable, which is what we said last year. It was 1,100 crores, and we should see a 35% growth over this 1,100 crores for the year as a whole this year as well.
What would be the mix in the upcoming launches, Mr. Singhal? Would it be catering more towards luxury or towards the mid segment? Where is the demand coming in right now as you speak?
So broadly, the demand is coming from upper mid and luxury. Ahmedabad is doing great for us. We've had one of our most successful launches a couple of months back. This is by far our biggest launch. We sold more than 600 crores of inventory at the time of launch. As of end of this quarter. So it remains upper mid and luxury market, broadly speaking. Affordable, we are not very significantly present in that space, but for us, upper mid is doing the best in that sense.
All right. And any further investments under the HDFC platform too? Will you be entering into some more partnerships?
Yeah, I mean, the platform still remains underutilized. As I said, 1,000 to 1,200 crores is the total investment plan next couple of quarters, and 1/3 of that should be coming from the platform, and the other two quarters should be coming from internal accruals and the debt that we just talked about.
Very quickly, Mr. Singhal, one final question. Is there any particular geography that you are targeting for further land acquisitions? The last time you spoke, you mentioned there might be some purchases in Bengaluru. Has that materialized?
Yeah, Bangalore, we just announced one very large, very nice project at ITPL Road near Whitefield. So Bangalore, one more high-rise has been signed after we signed one at Bannerghatta Road. Bangalore obviously is one of our prime markets. It's our second home, and hence we'll continue to consolidate it in that market. We should be able to kind of acquire 2 or 3 more projects within this year in Bangalore. And Ahmedabad obviously is our home market. Besides Ahmedabad and Bangalore, obviously we are targeting MMR as well. And by the end of this year, we should see some action happening on that front as well.
All right, take that point. Wish you good luck for the remainder of this year. And once again, a very happy festive season. Thanks a lot for joining in. At the bottom of your screen, you have numbers coming in from Symphony. There's a smidge of an up move on the stock, 1.5%, because of the revenue growth, which has come in at around 14.5%. The net profit, which is a 60% jump over the same time last year, which is trying to figure out if there is any exceptional out here or not. Seems like none so far, because there has been a big jump in the EBITDA as well. And now the stock is building on to those gains, now moving towards the higher end of the trading range so far. A part of it could be other income related, because other income has come in at around 20 crores. This compares with 11 crores. There has been, the EBITDA should come up for you on your screens as well. The other income has jumped from 11 crores to 20 crores. So that's caused a bit of a 10 crore jump in the net profit. EBITDA is up 56%. So operationally as well, it's not a problem. The other income has only boosted the net profit further. So that's a good set coming in from Symphony on a favorable base as well. So we have 14.5% revenue growth. Along with that, we have a 50% EBITDA growth and the net profit jumping 60% further, boosted by other income. And that explains why the stock now has moved to the higher end of today's trading range. We get more details on that and take a short break. But as we do that, let's tell you something about programming note as well. We prepare to ring in the festivities this Diwali. Tune into CNBC TV18 at 2:30 p.m. today to hear out the biggest market voices giving their tips on how you can make your portfolio prosper and a cracker this Diwali. Welcome back. You're watching us here on Halftime Report. Even as the market's doing market things, what's interesting are some of the internals which point towards maybe a bit of a bounce once again. Why do I say that? Because the Nifty's recovered smartly from the lows of today, and today's low itself is extremely crucial, because if you look at the Nifty over the last two trading sessions, yesterday we broke a 5-day losing streak, and the low yesterday on the Nifty was 24,135. The low today, from which we bounced nearly 100 points, a little more than that, the Nifty's low today was 24,140. So that's a bit of a positive, and that's something we'll manage, the lows holding on. And the second part, from a technical standpoint, the Nifty Bank is outperforming. It's crossed the 100-day moving average. It's crossed the 20-day moving average. The 50-day moving average is something it's very close to, 51,784. So we'll keep an eye out on whether that is crossed by or not. And it's not just the intraday move, it's the closing that matters when it comes to these technical levels too. Because for the Nifty, these levels are a lot higher. In the closing, we'll have the financial services expiry play out, and that will also have a bit of an overlap on the Nifty Bank. So we'll keep an eye out on that. 24,400 call and 24,200 put, extremely active. We have the index somewhere closer to 24,300 itself right now. For the Nifty, we have the 24,200 put, which is fairly active, telling you that today's low is an important support. These put writers are hoping for 24,150 thereabouts to hold on. But on the way up, around that 24,500 mark, 24,400, 24,500 mark, there is some supply expected. And that's visible in the kind of call writing that we're seeing at the 24,300 level itself for a premium of 122 rupees. Apart from the index, just keep an eye on a bunch of stocks. This is expiry week. Bandhan Bank and BHEL may enter FNO ban. Bandhan Bank, of course, down 4% today. And alongside that, we have Dixon, which has been in the FNO ban for the last couple of trading sessions, may perhaps exit FNO ban, and that explains why the stock has also seen a bit of a recovery from the lows.
Keep an eye out on all of these names. The Nifty also staging a recovery from the lows of the day. Keep an eye out on the markets. Time for a short break. On the other side, Shrikant Nadella, the CEO of KFin Technologies, joins us to discuss the second quarter and the road ahead. Stay tuned. Welcome back. KFin Technologies is the next management after reporting a good second quarter, beat across the board, margins expanded as well. The board also approved the terms of a joint venture agreement with CAMS for MF Central. Now to discuss this and a lot more, we are being joined by Shrikant Nadella, the CEO at KFin Technologies. Shrikant, good afternoon. Thank you so much for joining in. And I'd first like to start off by asking you about the road ahead as well, because the markets performed well in the second quarter. The third quarter has not begun on a very good note. But considering the fact that 15% of your AUM growth comes from the market, 15 from inflows as well, do you maintain that 18 to 20% revenue growth guidance that you had given earlier?
Very good afternoon, Harmaz, and happy Dhanteras and happy festive season to all. Thank you so much for having me over. Yes, yet another good quarter for us. Bet expectations exceeded our own budget. Way forward, as always, we've been cautious. We maintained a consistent view about the potential to grow top line anywhere around 18 to 20% and EBITDA margins around 40 to 45% on a CAGR basis. We understand and respect the fact that there can be quarters when it can be as exuberant as the ones we have seen in the past one or two, and we may also have quarters where it may be a little subdued. So, but on a CAGR basis, we believe, we continue to believe that there is strong secular growth fundamentals behind our business, which is not backed only by the mutual funds and ergo related to the securities market, but also a broader set of businesses, including international alternatives, the primary and the secondary market in the form of IPOs, as well as the pensions and the value-added solutions. So broadly, we are confident and comfortable to maintain our position.
All right. So a two-part question thereafter, and festive greetings to you, your family, and your team as well. One is yields. There has been a moderation in yields. That's largely due to telescopic pricing and larger share of passive. So what tools do you have for you to increase your yields going forward? And related to that, margins. Earlier you said that margins will remain in this 40-45% range. Are you consciously looking at margins at around this 45% range itself, or do you at some point look at crossing it beyond that 45% as well?
Good afternoon, Manglam. So the yield, as we all know, is a factor of individually negotiated contracts with each and every asset management company. Telescopic pricing is baked in, which is no different than a volume discounting in the context of a manufacturing scenario, and we are duty bound in order to pass on the benefits in the form of scale and efficiency we derive to our customers in the context of overall growth, and to make mutual funds one of the most competitive product and well-generating asset for the Indian investors. What factors do we have? What levers do we have to ensure that there isn't a big drop? I think more than anything else, it's focusing on a diversification. It is a fact, empirical data points to yield that would come down as the overall assets under management keeps expanding. One thing that we can do, and we've been successfully doing, is winning a lot of new asset management company mandates. As we all know, the yields tend to compress when the AUM expands very, very large and very fast. But obviously, winning a lot of new asset management company mandates would provide a little bit of hedge in terms of the basis points being higher. Second, and more importantly, to focus on the diversified business. We have been, and we are, and we aim to be the first largest global fund administrator from India. Today, we are present in 6 more countries, and in each of those countries, we do not have yield compression. In fact, we have yield expansion, both because we have our commercials are designed in a manner that we actually have yield expansion happening every 3 years. At the same time, we are also rendering more business services than what we render in India. In India, it's largely RTA services, but abroad, we're able to render fund administration services as well. So together, and a significant amount of value-added services in the form of big data, analytics, cloud solutioning, CRM, mobility, so on and so forth. These are the controllable aspects of our business, which are not dependent on the vagaries of the business, of the market, and hence the yield compression.
Now, Shrikant, you have also finalized the terms of your joint venture with CAMS. How does that impact the entire ecosystem overall? And would that now create a level playing field between the two companies?
So the joint venture is actually something that is taking shape now, but the genesis of which predates almost by 2.5 years when we launched the MF Central. So in spirit and in essence, our joint venture was and had been live for almost 2.5 years. Many a mutual fund investor had been successfully using MF Central as a platform of choice, both for getting their transactions processed as well as for service request processed. This is probably the only platform of its kind for any BFSI sector anywhere in the world, where the entire industry has come together on a singular platform to drive ease of doing business. So for us, the joint venture, the formalization of joint venture, however, marks an important step in terms of creating a separate entity. A creation of separate entity has both tactical and strategic outcomes. The tactical ones being more and improvised solutions and services to the investors, distributors, and the fintech system, ecosystem at large. So what you would expect to see is, much closer tie-up and working with the entire fintech industry again to drive the mutual funds as a preferred choice of asset class across the globe. The separate entity would also have independent board, independent management, which effectively means there is going to be a focus to drive the business in its standalone basis, with obviously the support from the two equal shareholders in the form of CAMS and KFin. So we mark, this is a very important milestone for the industry as well as for this organization.
Take that point. Thank you so much for joining in as always and giving us, your views on the business going forward. Wish you once again happy quarters. You said that some may moderate, some may see exuberation. I hope that there is more happiness in the quarters going ahead than there is moderation, and that's for the entire markets as well, given the sort of, soft October that we've seen so far. It was correction which was due, correction that has come by as well. Meanwhile, there's some important news coming at the bottom of your screen. Board has approved the merger of Suzuki Motor Gujarat with Maruti. This is Maruti. The board is meeting for earnings as well. So obviously, we will keep getting decisions from the board as and when they are announced to the exchanges. But you know what? It's 25 years of excellence for CNBC-TV18. And on account of that, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit. We bring together visionary policymakers. We have the Finance Minister Nirmala Sitharaman. That's not all. We have the RBI Governor Shaktikanta Das, industry leaders like HSBC India's Hitendra Dave. We have Narayan Murthy. We have Kotak Mahindra Bank's Uday Kotak and the trailblazing startup founders. All of them coming together to tell you what the roadmap for the next 25 years of growth for India are. We're looking at global leadership and the path that will be charted for that. You don't want to miss this.
Welcome back. It's a 150-point recovery from the lows of the day for the Nifty, now almost recovering all the losses. And as flashes on your screen, the Afcons Infra IPO has now been fully subscribed. Remember, it is a final day of bidding, so keep an eye out on that as well. But some stocks, Symphony has now taken a nosedive after the initial spurt that had come up after the results were announced. Now the stock is down 5% as we speak, 5.5% now after the lowest point of the day, 1550 now on Symphony. Also pull up Dabur reporting results tomorrow, and that too is trading with losses of close to 3.5%. But where are the gains coming from on the Nifty? It's ICICI Bank that is leading the Nifty Bank higher and subsequently the Nifty as well, and also is State Bank of India, which is also the second best contributor on the index and taking the PSU Bank index higher as well. Top sectoral gainer yesterday, top sectoral gainer today as well. Time for a short break. On the other side, Manisha Gupta joins in with Dilip Gaur of Novel Jewels, the Aditya Birla Group. Stay tuned. Welcome back then. On to our special for Dhanteras. Manisha Gupta caught up with Dilip Gaur, the business director of Novel Jewels of the Aditya Birla Group, and spoke to him on their expansion plans, growth and innovation strategies, and how the festive demand is shaping up. Listen in.
I think it feels great to do this, grow at this speed, and I believe we'll be able to maintain this speed going forward. We hope to do maybe 100 stores next year if it goes, all goes well.
By the end of next year?
End of next year, sure.
All right. Mr. Gaur, first things first, and what really has led Aditya Birla into jewelry business? What are the key 3 points that you feel that you can grow within this business, make a mark?
Yeah, I think the reason for us getting into this business is one of the things it has always been on our radar. But the biggest driver has been the formalization of the market. If you remember, this market used to be a very fragmented market. So last 5 years, it has gone up from 20% to almost 35%. And it's moving very fast. So I think the policies have changed. The government's progressive policies have made it easier for companies like us to operate. So I think that's one reason. The second is it's a huge market. It's about 6.7 to 7 lakh crore market, going in double digit. So we believe there's a huge growth opportunity. And third is we have been the leaders in the retail. So I think it's a natural progression from fashion to jewelry. And finally, the biggest thing is that trust is a key cornerstone of this industry.
Sure.
And I think when it comes to trust, I think Aditya Birla Group has a very special place in that. So I think we believe it's a win-win combination for all of us.
So what are the investments that you're putting into this business right now? What kind of return growth are you anticipating, and how are you looking at the next 1 year then?
See, it's an evolving landscape. So I think investment will depend upon how we grow and how the market unfolds. But it's our intention to spend up to 5,000 crores in the equity investment. So that's the plan, and the idea is in the fullness of time to go nationally and have about 350 to 400 stores of much larger size than the industry average.
All right. This one I understand is 7,000 square feet. You have a 14,000 square feet as well. Is that the limit, or are you looking
Yes,
at?
so our idea was to have 7 to 8,000 square feet average store size, which is about 25 to 30% more than the industry average.
It is.
This being a mall store is 7,000 square feet, which is pretty big. But our high street stores are as big as 12,000 to 10,000 square feet. It will depend upon the kind of market it is and the kind of city we are in. And some stores, you know, are flagship stores, so we'll make them much bigger.
If you look at the market, well, absolutely. From being a not very organized sector, 35 to 36% of the market is now organized. Is that a big plus point that you see? And the second thing really is about on what is going to be your priority for this business. Is it going to be designs, customers, price points? What are you working on?
I think you are right, because that's where the growth will come from. The 65% unorganized market is what gets formalized. So just imagine 65% of 7 lakh crore. That's the kind of growth pie which you all have. So I always say there's enough room for everyone to grow here. There is we don't worry about competition. We worry about what we are going to do, and we are going to do right. And what we have done is we have done a very deep consumer research before we got into this business. About 4,000 consumers we have talked to them, spent time with them, and got very deep insights. And first big insight has been about the design. So I think in our case, the product is the hero. And I think we would like to create a business where design is at the center. And in the evolving landscape, the Indian consumer also is now moving from buying jewelry as an investment to statement. And in that evolution phase, the Indian consumer is looking for better designs, better innovations, so which is what we'll provide.
This store has how many designs?
This store has, we have total about 15,000 designs, of which about 6,000 to 7,000 designs are in the store.
In the store as well.
And on top of that, what we are going to do is every 45 days we'll have new design collections coming. So we'll keep on upgrading design, because design is not a static feature, it keeps a dynamic feature.
It is. Everything
so that's
changes.
our major proposition, that we will keep on innovating our designs and innovate our offerings to the consumer.
Mr. Gaur, this is your first Diwali, and it comes at a time when the gold prices are trading at an all-time highs. What is your sense getting into this season with prices at these levels?
Yeah, I think, yes, the general belief is that with gold prices going up, the demand should come down, but I think what I'm finding is festival has a different spirit altogether. And at the end of the day, gold has a beauty that it's an investment and adornment together. So you can look at both ways. If the price is high, it's an investment. If the price is low, it's adornment. So you can look at that. To my mind, I think we expect a very good festive season. The initial signs are very good. And we have done a lot of work to make sure that we do well in the... So we have got 2 special collections launched for design.
Okay.
What we call One Jyotsna and Lush Gold. Okay. So we are giving consumer a very festive-driven collections. We've also built up a very festive specific campaigns. We've got a film made for Diwali, film made for Karwa Chauth. So that kind of, so we are kind of giving
So
customers.
Indria is one brand that comes under Novel. Are you looking at more brands under Novel going forward?
No, I think our belief is Indria will be a brand which can transcend the entire range. I think we are,
All right.
it's a very
Okay.
premium brand we are trying to build. Indria, as you know, the word stands for senses.
Yes.
And we believe that Indria it will kind of activate all the 5 senses of consumer, and that's how we will entice them. So our whole branding strategy is that it's a very premium branding and it can transcend the entire range. Like I always say, it's like a BMW or a Mercedes. You don't need to have a separate brand.
All right, got that.
Exactly.
So you've talked about 100 stores in total by end of next year. You've also talked about 300 and 400 going forward as well. So are there any cities that you're looking at? Are you looking at, have you identified all the places?
No, so we have a blueprint done, but I think we'll be a pan-India player. But the business will grow depending upon, in this business, the very important part is, apart from growth, availability of good real estate.
Sure.
So we go where we get the best real estate and best locations. That's what drive it. So,
Is plan also inclusive of going or stepping out of India at some point in time?
as of now, no. We believe there's enough to do in India. But we never know. In fullness of time, we'll see what to do. But in the next 2 to 3 years, our focus is India. And we believe there's a huge growth opportunity. And we would like to be in the top 3 players in next 5 to 7 years' time.
Also within the store, I've gone around and seen it, and you have gold, and you have polki, and jadao, and diamonds, and antiques, and there's a whole host of collection around here. Is there a special focus on something special, or are you going all out with everything?
No, I think we are designing and creating products for occasions. So we believe a same consumer buys different product at different times. So when there's a wedding in the family, he'll have a different product. When there is a festival, there are different products. So we are creating products for the occasions and not a fixed kind of product. So we are going more by the consumer need. So I say I will give whatever consumer wants.
Canara Bank's numbers were flashing on your screen just a few minutes ago. The net interest income was marginally higher than expectations. The net profit was in line, but the bigger takeaway is the fact that the asset quality has improved on a sequential basis. Both gross and net NPA in percentage terms as well as in absolute terms is also improved compared to the June quarter, showing up in the stock price as well. Marginally higher has recovered from the lows of the day, trading with gains of around 0.5%. With that, it's a wrap on this edition of Halftime Report from Mangalam, me and the team that put this show together. Thank you for watching. Festive greetings to all of y'all. Business Lunch takes the action forward as we await the 4 Nifty earnings.